I'm delighted to be here for several reasons, not just because I'm co-chairing an early stage company which provides financial information, some of whose research I'm going to draw on, but also because many years ago when I set up a business and expanded it in the city and then sold out of it, one of the things I did is exactly what you're doing, which is to invest in a whole series of startup companies. I did okay on it. I think overall you know that you're going to win on some and you know you're going to lose on others. The portfolio principle is important, but beyond everything else, I think I found it a fantastic exercise in keeping in touch and being able to help early stage businesses, often who need experience. So I'm delighted to be here for both of those reasons, and of course having been Secretary of State for Energy and Climate Change and previously supporting this conference, I'm absolutely convinced of the importance of what you're all doing today. So let me just start with what I'm going to try and tell you. The overview. First of all, there is an old-fashioned view that green action is somehow costly, and it's a costly diversion from the real things which are smelly, dirty, polluting, and make money. If you wanted to sum it up, that would, I guess, be the underlying assumption of somebody like Donald Trump. There's an old view, too, that lower carbon means if you're going to invest in lower carbon, you're going to have to accept lower returns. There's a sacrifice. I want to tell you that's not true. In terms of the work that we've done at ET Index Research, it's very clear that lower carbon risk goes with higher returns. Now that's from the public markets, so it's obviously companies that are already listed, but it is, for a lot of the people who'll be presenting today, I assume, an ultimate ambition to exit in public markets. And it's very interesting as to why that may be happening. I think there are three theories as to what is going on, and I'm going to go through the reasons why it might happen. And I'm finally going to attempt to be reassuring to investors about what is going to happen as a result of the election of Donald Trump. And I believe very firmly that Donald Trump will slow down the trend towards tackling global warming, but cannot stall it. Frankly, the genie is out of the bottle. And what you're going to see in some of the slides I show you is so irreversible that we're not going to be able to, nobody, not Trump or anybody else, is going to be able to play the role of sabotaging this agenda. So the conclusion that I come to is that you can do good and you can do well as an investor. So look at low carbon generating higher returns. Now, 4 independent studies have now come to this conclusion. ET Index Research's low carbon index outperforms global equities over 5 years. So if you take a straightforward market cap weighted index, MSCI All World Index, and you compare it with a low carbon tilt index, completely diversified across 2,000 plus companies in every major stock market, you actually get an outperformance of about 1.5% to 2% a year, depending on how much you're actually going to see when it comes to the reduction in carbon risk. A study by Trove Research, Guy Turner led it, was the former chief economist at Bloomberg New Energy Finance. He has come to the same conclusion, outperformance of sustainable funds over 3 and 5 years. BlackRock, scientific active equity team, shows that investors can use emissions data to generate superior returns. That came out in October 2015. BlackRock being large, as you know, the biggest fund manager in the world, hasn't produced the underlying data on that. And Osmosis, a fund manager, has just raised more than $500 million from Scandinavian funds, mainly the IKEA Foundation, after showing higher returns from low carbon investing. So what I'm trying to show you today is trying to knock on the head the old-fashioned conventional wisdom that somehow you have to take a haircut, you have to take lower returns to invest in this area. That's not what the evidence shows. So that is the ET Index research. You can see going back over the 5-year period, how the outperformance is clearly there. And it's over 5 years, 7 to 11%. This is pretty significant, given that you've got here a completely diversified portfolio, exactly as if you were weighting the different companies according to their market capitalization. So that's very, very clear. And what is interesting, the way we do this is by rank ordering companies according to their carbon emissions and then reweighting according to the rank ordering. So you can have an aggressive index or you can have a less aggressive index, but the reality is that what you find is outperformance. The more aggressive the index, the higher the outperformance, which is interesting. So we're going to talk a bit about why this might be the case. What are we picking up? Trove Research, and I've put here, I think the presentations will be available to all participants afterwards. I put down the various sectors and the funds and their performance on the Trove Research study. And I'm going to give you 3 theories of what's going on about this low carbon outperformance. The first theory is because what is very noticeable is that it doesn't matter what the sector is. We're not talking about simply getting out of fossil fuels or getting into clean tech. If you take a sector which you don't necessarily think of as being associated with the move to a low carbon economy, like advertising, you find that WPP has low carbon emissions and outperforms its rivals in that sector. Sky Television, James Murdoch, unlike his dirty digger dad, was very committed to this area. Actually invested a lot in things like low energy data centers. Sky has outperformed some of its rivals in the television sector. So this isn't just energy, it isn't just clean tech. So one of the things we may be picking up here is that good managements foresee problems like climate change. So low carbon is a sort of proxy for effective executive teams who are looking around the next corner, attempting to see what the problems may be, and heading them off. There's also undoubtedly an element on the demand side, because we've seen an increasing number of funds from universities, charities, endowments, family offices that are beginning to be run by millennial generation, which is much, much more aware of this issue. You've begun to get extra demand coming in for low carbon companies. So there's been a steady increase in assets that are managed sustainably, and that is reducing the cost of low carbon capital, and it's bringing gains for asset holders as the risk premium falls. And finally, I would say another explanation for what's going on is that low carbon companies are less at risk of disruptive technologies. So if you're sitting in the coal business, you are a prime target for people in this room. You're a prime target for a lot of other businesses that are moving very quickly towards a low carbon future. And you're absolutely in the line of sight for what has been happening with some of those technologies, and it's very exciting what's happening with some of those technologies. I said I'd talk a little bit about President Trump. I don't like doing it, but hey, somebody has to. I'm not going to pretend that President Trump is good news for this agenda. He is clearly not. If I had a vote in the American elections, I would not have voted for President Trump. His sabotage of the Environmental Protection Agency and the Clean Power Plan will slow US decarbonization. But there's a very important but here. Cheap US shale gas is driving coal out of the US and elsewhere and is halving coal emissions due to electricity generation, because as soon as you replace a coal-fired power station with a gas-fired power station, you effectively halve the amount of carbon emissions coming out for the given amount of electricity. And the decline of wind, solar, and battery costs is now unstoppable. Even in parts of the US, in the sunny south, in Texas, Arizona, Nevada, you've actually got costs for solar which are not only beating coal, they're beating gas. So in completely unsubsidized Texas, you've got solar arrays being put in place, by utility companies simply on the basis that the electricity that they generate is cheaper even than artificially cheap US gas prices. And the political commitment to climate action is likely to mount as recovery continues, in my view, in other parts of the world. So Trump will slow, but he won't stop the low carbon movement. This is actually the paradox. If you look at what has happened for the first time globally in the last 3 years, we have seen global emissions from burning fossil fuels peak and plateau. And that has happened despite continued increases in China, in India. It's happening essentially because of the changes going on in the US with the generation of electricity from gas and the fall in US emissions. And that is going to continue. Whatever Trump does with the EPA, trying to stop this trend is like King Canute trying to stop the waves. And that's the first victim. You can see here the long decline in the gas price, the coal price, and now there's even greater incentive to generate from gas in the US. That is going to go on. The cost of solar and wind is right behind gas. I said that in Texas you can actually invest in solar and beat gas, and that's going on. And the cost of solar and wind, the fall is absolutely astonishing. Every time there is a global doubling of solar array installations, you're seeing a fall in price. That must be President Trump just trying to correct me. You see a fall in price of something like 17%. And with wind, you're seeing the same thing. And I have to say, I was a skeptic about offshore wind. I think onshore wind, it was very clear that the prices were coming down dramatically, but the same thing is now happening with offshore wind. And you had an astonishing auction in Germany only a couple of weeks ago, where the cost of offshore wind came in, admittedly with the connection costs picked up by the government, but the cost of offshore wind came in at lower than the cost of market electricity, 44 euros per megawatt hour. So this is an unstoppable revolution. You're seeing increasing parts of the world where actually people are going to be investing in low carbon energy for the very simple reason that they can make good returns on it, and that is nothing that Trump or anybody else, however crusty, telegraph reading, climate change denying, old finance director they are, they're going to have to get with it, because this is an unstoppable revolution. The cost of batteries is also coming down. So you combine the falling cost of batteries, important for electric vehicles, important for rearranging electricity during the day when the sun isn't shining, when the wind is not blowing. They are coming down as well. And low carbon disruption is clearly mounting. Biggest coal company in the US, Peabody, going into Chapter 11. And you can see I've put a number of other instances here on what is happening with low carbon disruption. So if you're in the low carbon sector, you're out of the firing line for the disruption that is inevitably remodeling the low carbon world. And that's a very positive message for investors who want to be able to make sure that their portfolio is avoiding losses. Investors, oddly, particularly big ones, not I'm delighted to see probably people in this room, but particularly big investors hate losses more than they crave gains. And if you hate losses, then get out of things which are going to be disrupted by low carbon, because you are going to be losing money on them. So the conclusions on low carbon. Let me just sum up what I've said today, what I told you I was going to say, what I've told you, and now to go back on what I've said. Low carbon risk cuts the chance of catastrophic portfolio losses for investors. That's really important. 4 independent studies find evidence of outperformance, not sacrifice. So don't buy the old line that low carbon is somehow going to cost you in terms of the returns on your portfolio. The evidence is the opposite. Technology may now be more powerful than policy. Sorry, Bays, I'm not sure where you are in the room, but the reality is the genie is out of the bottle on low carbon technologies. We've done the work on wind. We've done the work in policy terms on solar, on offshore wind, and now nobody can stop the consequences. So Trump can only slow, but he cannot halt decarbonisation. And investors who move first are inevitably going to get ahead of the market. Thank you very much, and I hope to provide you with a bit of optimism for your deliberations today and many successful investments in what is going to be an increasingly important space.